What is going on? So on the Saturday class, I did introduce you guys to changes in accounting policies. All right. So in respect to that, I said when you're looking at changes in accounting policy, mostly we're looking at changes in inventory valuation. All right. That is the most common one when we talk about accounting policies. All right. So in respect to this, right, before you do anything, you need to understand now, in terms of changes in accounting policies, they can ask us, all right, they can ask us the notes for changes in accounting policies, all right? So it's important that we know that we covered everything, all right? So let's look at changes in accounting policies. Right, possible questions in the exam. What are you expected to know? So we need to know the change in accounting policy note. All right, so this will cover today. And then two, we need to know the effect of the changes in accounting policy on financial statements. Right, so in regards to this, what we are saying now is we need to know preparation of financial statements after change in policy. Right, if time allows, we'll look into examples. If not, we'll do it tomorrow. Right, and then, yeah, so these two, right, are the most common elements that they can examine us in regards to changes in accounting policy note. Right. So let's look at our diagram now so that we have a better understanding. Now, guys, when we have a change in accounting policy note, right, in terms of accounting, we are required to adjust the prior financial statements. So the change in accounting policy, it affects the previous years. Change in accounting policy result in adjustments of prior year financial statements. Right. We can all agree that in regards to financial statements, we have our financial statements audited. We have our financial statements fully prepared and we have closed them. Right. Let's take, for example, we're in 2023. We can all agree that with companies that have 31 December 2022 year end, they've already done the audits, they've already closed their financial statements, most of them, right? But should it happen that we do a change in the valuation of inventory in 2023, it would mean now, right, that we have to open the 2022 financial statement, the 2021 financial statements, 2020 going back, in as much as the information allows. So that is what IFRS requires us to do. All right, so it's very important that you understand that. All right, we're going to be looking at changing accounting estimates in the few classes to come. So please understand, when you look at changing accounting policy, we open the previous year financial statements. All right, and then changing accounting policy note. Note, right? How does the note for changing accounting policy now look like? Right? Remember, we said they might ask us this. All right. So, in respect to the changing accounting policy, they want you to do a description. All right. So you do a description of the events that took place, right? What caused the change, right? Why did management decide to change? What caused the change, right? And then you also you have to explain as well, right, the calculations or effect of the change. Effect of the change in accounting policy on, so effect of the change in accounting policy on 1, statement of profit and loss. And then 2, statement of financial position. So it's very crucial that in regards to this, when you do the change in accounting policy note, all right, let's have an understanding that we do the note with the effect in the statement of profit and loss, as well as the effect in statement of financial position. Right, let's look into it. All right, there's a small example. I believe you guys did come across the document that I shared with you guys there. So let's look at this question. So it says, prepare the statement of profit or loss and other comprehensive income expenses by function. I'll show you what it means. The statement of changes in equity, only retained earnings section, and the notes are there too of elegance. So can you see they want us to do 3 things: statement of profit and loss, statement of other comprehensive income, as well as the notes. So those are 3 things that we're expected to do for the year ended 30 September 2012 in accordance with International Financial Reporting Standards. All right, so let's quickly go and see. The following information is an extract from the trial balance of Elegance Limited at 30 September 2012. The company is involved in the manufacturing and selling of furniture and curtains. So we have sales of furniture, sales of curtains, cost of sales, interest received on staff loans, retained earnings at beginning of year, loss on sale of machinery, and then tax on loss of machinery, 3,000. Advertising cost, bad debts written back, SA revenue service, 6.2. Loss as a result of the expropriation of land, not deductible for tax purposes. Current tax expense, dividend paid. Additional information. Assume that the calculation of the current tax expense is correct in the trial balance above. After the aforementioned information had been obtained from the accounting records of the company, the directors of the company decided to change the accounting policy with respect to the valuation of inventory. Elegance Limited previously accounted for its inventory on the last in, first out method, but it has changed its policy of accounting for inventory to the first in, first out method in order to comply with the requirements of IS2 inventory that disallows the use of the LIFO method of inventory valuation. The value of inventory based on the 2 methods was as follows. So at 30 September, so these are the values of inventories that we have. Assume that all amounts are material and that the tax rate has remained unchanged at 20%. The SA revenue service will not reopen the previous year's tax assessment, but the new policy will be accepted for tax purposes. Right. The implications of capital gains tax and dividend tax should be ignored. Right. So in regards to this, we want to look at, so the first step when you see a question in regards to this, be it you want to do the calculation of the statement of profit and loss or statement of changes in equity. The first thing that you need to do is to do the note, all right, on your changes in changing in policy. All right, so let's do now notes to the annual financial statements. Right, and then we have change in accounting policy note. Right. So the first thing when you're looking at changing accounting policy note is to give a description of what transpired. The logic behind this is, remember, we have users of the financial statement who are not part of the company. Let's take, for example, MTN. Right, we can all agree that if MTN decides to change its accounting policy note, all right, the stakeholders were not part of the company. Those guys, now, if they see figures flying, they might be confused. They need to understand what really transpired. All right. So what do we do in regard to this? So the change in accounting policy note, what we do, we write down this information. All right. So can you see after the aforementioned information have been obtained from the accounting records of the company? So you can start off by saying, the directors of the company decided to change the accounting policy with respect to the valuation of inventory. Allegiance previously valued inventory using blah, blah, blah. So in this case, you just copy this information as it is. All right. So let's do that. All right. The directors. So we have the directors of the company, or you can summarize as long as it does not lose its meaning. Right. The directors of the company, all right, decided to change the accounting policy, right, on the valuation of inventory, right? They decided to change the accounting policy on the valuation of inventory, all right? Allegiance previously accounted for its inventory, all right? So write down. Or someone can say it from, all right? You can say from, last in, first out. To first in, first out method. All right. And then you state the reason why are they doing that. All right. In order to comply with the requirements of IS2. All right. So you write down in order to comply with the requirements of IAS2 inventory valuation. Right. All right. And then you state, all right. So you then state the change has been accounted for retrospectively. All right. Let's look at what does the word retrospectively mean. Retrospectively means we opened the previous year's financial statement. All right. Then you write as follows. All right. So the change has been accounted for retrospectively as follows. So it means you're telling the users of the financial statement that you opened the prior financial statements. Right. Now, let's look at workings, right, in regards to the change in accounting policy. So in respect to the information that we have, right, we can see they gave us the information in respect to inventory. Right? So we have inventory that is valued at last in, first out for 2009, 2010, 2011, 2012. And then we have inventory, right, that is valued in terms of the first in, first out method for 2009, 2010, 2011, 2012. So let's do this. So step number one, right, we calculate the movement in inventory. Sometimes they give you this, sometimes they don't, right? So like in this case, they did not give you the movement, so you have to calculate it. All right, so let's do, we have 2009, 2010, 2011, 2012. Right, so you can see in regards to this, we have 45,000 and 48,500. Right, and then the other year, right, 2010, we have 62,500 and 67. Right, and then in 2011, we are looking at 32 and 37,500. Right, and then 2012, we have 26 and 33,700. Right. So this is what you have. You have your LIFO and then you have your FIFO. Now, what is the movement? All right. So in regards to this, so you're going to take the new method, right? Your new basis is FIFO. So you take FIFO minus LIFO. So movement, FIFO minus LIFO. Right. So that's your movement. So in this case, there's 3,500, and then here you have your movement looking like that. So you can drag your formula like that. All right. So that's what you have in respect to your movement for the inventory. Now, can you see your inventory balances are actually increasing, all right, because of the new basis? We can all agree that the inventory balances did increase there. All right. Now, we now want to do what is the effect. The next step is what is the step 2? What is the effect? The movement in the statement of profit and loss. So on your statement of profit and loss, what is the effect of these movements, right, in your statement? Now, you're going to find out now in regards to this, the statement of profit and loss, we record cost of sales, right? That's what we record in the statement of profit and loss. And we say opening inventory plus purchases less closing inventory. That's what we do, right? In respect to cost of sales. So let's do the calculation of cost of sales. So we can start off with the most recent year, 2012, and then we do 2011, then we do 2010. All right. So when you do the comparison, you just do, for comparative purposes, you only do the 2 years, the current year and the prior year. All right. So in regards to this, that is what you do in respect to changing accounting policy. 2010, you don't do as well. So you take opening inventory. All right. Purchases are not affected. So you don't, there's no effect. And then you have closing inventory. Right. Let's look at, let's start off with 2011. Right, this is 2011. We can all agree the closing inventory for 2011 is increased with 5.5. All right, so the closing inventory for 2011 went up with 5.5. So there's increase. All right, so you have increase in closing inventory. So the closing inventory for 2011 went up with 5.5. You guys see that. All right, so it increased there. And then the closing inventory for 2012, it went up with 7.7. Closing inventory for, so not 2012, closing inventory for 2010 becomes opening inventory for 2011. We can all agree that, all right? So in regards to this, the closing inventory for 2010 is 4.5. It increased with 4.5, which means opening inventory for 2011 is also supposed to increase with 4.5. I'm sorry, it looks like, I don't know if my class will manage to end, but let's see. Our power never came back after load shedding, and my inverter, see, it's now flickering, but we'll see. All right. So which means now, our opening inventory, right, is looking like that. It increased with 4.5, and then the closing inventory went up like that. So let's do this. So closing inventory now for 2011 becomes opening inventory for 2012, which means 5.5. Now, what is the closing inventory for 2012? It is 7.7, like that. Now, let's do the calculation of cost of sales. Right? So cost of sales, we're going to take now, all right? We're going to take now the balances, which like opening inventory minus closing inventory. That's what gives us cost of sales. So that's what we have, all right? So opening inventory minus cost of sales. So can you see cost of sales is decreasing? So there's a decrease in cost of sales. See that? Then you go to your notes. All right. So on your notes, what do you record? So you have 2011 and 2012. So you record decrease in cost of sales. So you record your balances. So the decrease in cost of sales for 2012, it is 2.2. Decrease in,
Ian,
yes, ma'am.
I'm sorry. Yeah, I wanted to ask you, are you tired?
Okay, all right, thanks. Thanks for that, Isabel. So in this case, the closing inventory for 2011 is 1,000. So there's a decrease in that. Now, the next thing now is when you decrease cost of sales, what happens to your profit and loss? Profit before tax.
Hi, Ian.
Yes, ma'am.
How are you?
Good.
I just wanted to understand if we got the answers as positive. So are we going to record as increase in cost of sales?
Okay, yes, of course it will be increase in cost of sales. Yes, you're 100% correct. So in other words, she's saying, suppose opening inventory was more than closing inventory. Yes, you're 100% correct. It will be increasing cost of sales.
Okay.
All right.
Thanks.
Perfect. All right, please. So here we have decrease in cost of sales, looking at that. So if we decrease cost of sales, what happens to profit? Or what happens to tax? So we can agree profit before tax.
It increases.
Increases, all right? Which means income tax also increases, right? Yes. So in this case, we're going to have increase in income tax. Of how much? So income tax increase now is going to be 2.2 times your tax rate. So in this case, the tax rate was 20%. All right, you can see it was 20%. So you multiply now 2.2 by 20%. And then the other one, you have 1,000, you multiply by 20% as well. All right. So the increase 2.2 multiplied by 20%, you record it as a negative. And then you have 1,000 times 20%, you record it like that. Then the net amount of these two, right? The net amount. The net amount of these two now, this is what's going to give you now. It's going to give you increase in profit after tax. Right. So you're going to have the net amount, right, of your decrease in cost of sales, net of increase in income tax. So that's what will give you that. All right. So you have that. So you're done with the statement of profit and loss. Now, the next thing, now you move on to statement of financial position. Right. What do we record in statement of financial position? All right. So in the statement of financial position, we can all agree that we record closing inventory only. That's what you record in the statement of financial position. So in respect to this, so you can see you record for 3 years, all right, your closing inventory. You record information for 3 years. I'll show you guys just now why we do for 3 years. All right. So our calculation now, we're just going to take. So we've already done the calculation of closing inventory. So we saw closing inventory. It was increasing there. So our balances was going up. So for 2012, closing inventory went up with 7.7. All right. So we have increase in closing inventory. All right. So for 2012, it went up with 7.7. And then for 2011, your closing inventory went up with 5.5. All right. And then for 2010, it went up with 4.5. Right. Now, the next thing, now I want you guys to listen, right, properly, in case someone was sleeping. The next thing now is what are the effects of the increases in closing inventory. closing inventory on taxation. Right. If SARS agree to open prior year, then increase in closing inventory would result in increase in income tax expense. Right. If SARS refuse, right, or reject new method, refuse to open prior year, this would result in increase in deferred tax liability. Right, I'll show you guys just now while I'm giving you these notes. So let's go to our question. Oops. All right, I pray we'll be able to finish. So in terms of our question, we can see the SA Revenue Service would not reopen the previous year's tax assessment. So SARS refused, but the new policy will be accepted for tax purposes. All right. So SARS refused to open the prior year, which means they're only accepting it in the current year. Right. What is the effect of that? The effect of that now, in 2010, we're going to have increase in deferred tax. If I go offline, just know my power went off now. Right. So increase in deferred tax for 2011, it will be 4.5 times 28%. And then in 2011, which is the prior year as well, it will be that. Then in the current year, SARS accepted this policy, which would mean now we have increase in income tax of 7.7 times 20%. Right, of course, we record these as negative amounts. Right, so that's basically where we are sitting at. So we then net off our balances like that. So this is what will give us increase in equity. Right, so we have our increase in equity looking like that. And then we have adjustments now. All right, so this increase in equity will result in adjustments in retained earnings. So we're going to have increase in retained earnings. Right, so the equity balance for 2010, it will result in increase in adjustment of retained earnings for 2011, the opening balance for 2011. Then the increase in equity for 2011 will result in adjustment of retained earnings for 2012. So that is basically how the change in accounting policy note is supposed to look like. Right, any questions, guys? Questions, guys? All right, I guess
Sorry, Ian.
Yes, ma'am.
The increase in retained earnings, where did you get that amount from?
These ones.
The 3,200? No. In retained earnings, the 3.9 and the 3.2.
It is these balances. You see, we net off increase in opening inventory minus increase in deferred tax. It gave us 3240. So which means this is the closing balance of retained earnings.
Okay.
Then it
Now I got it. Thanks.
All right. Cool. Any questions, guys? All right. Cool, guys. If there are no questions, we'll pick it from here in tomorrow's class. I know my power went off any minute from now. All right. Have a lovely evening, guys. I'll share the recording with you there.
Thank you, Ian.
All right.
Thank you.
Thank you so much.
Bye, guys.
Bye.
Yes, yeah.
Bye.